And now we have our final keynote speech of the day. We're going to be joined by Sébastien Duquet, the Director and Head of Relations at Mirova. He's going to share his lessons learned from the unique experience that Mirova has and the current trends. So please welcome him up on stage.
Good afternoon, everyone. Last speech of the day. So I will explain how a mainstream asset manager, let's call it robust asset manager by comparison to the emerging asset management company that we have heard from this morning, is using blended finance to complement its general strategy. So first of all, Mirova is known here in the room mostly for what we do in renewable energy and natural capital in emerging market, but actually that's a small piece of the asset we manage. We have 30 billion of assets under management in impact investing strategy, all SFDR9, and out of those 30 billion, 25 billion are in listed strategy, where we manage a green bond fund, fixed income and sustainable equity, and 5 billion are still in private assets. What enables us to reach such a magnitude is also a unique access to Natixis Group. We are a subsidiary of the second largest European asset manager and the second largest European bank, BPCE. And when it comes to listed strategies, they promote the fund to retail clients. We have 13 million of clients in our listed strategy. And we are the only impact investing asset management company inside this group, Natixis. We generally look at, if you look at our private asset strategy, we both have a strategy for developed country and for developing one. So for instance, in energy transition, we are active for the last 10 years in financing equity infrastructure in developed markets through funds that are unitranche, offering to institutional investors a very classical infrastructure risk on return. Complemented by a strategy for developing energy transition in emerging markets. So in several of those strategies, we both are active in developed and developing countries, while in some, like private equity, where we have both private equity fund for clean tech and private equity fund for social activities such as education, healthcare, for today we are active only in developed markets. Why it's important is because we will use blended finance only if we feel that the product we are structuring does not match the interests of institutional investors. So we really start with institutional investors on whether they are capable in investing in terms of risk-return profile into a fund, and whether we could offer them this fund without taking too many risks for them. And that is why we go blended only if we feel the strategy is still too risky to be proposed to institutional investors without this first loss tranche. Otherwise, we'll not do it because it's a lot of energy, a lot of time, and it will be useless. And that's why 99% of the assets we manage are non-blended finance assets. Still today, we use the strategy when, as said, we believe the risks are high, and when sometimes there's also a need of accompanying the investee with some technical assistance facility. So the two main strategies where we use blended finance are decentralized clean energy, so renewable energy in emerging markets. We see typically, you see here, typically the sector where we invest in, it's off-grid solar equipment, agri solar equipment, water pumping, solar irrigation, commercial industrial solar equipment, etc. So when we launched the last vintage in this strategy, we have been active there for the last 15 years. So when we launched the last fund, the Mirova Gigaton Fund, 2 years ago, we asked ourselves whether we could go non-blended for this time. But if you look at the probability of default of those different sectors, it's varied from more or less 12% for the off-grid solar based on our historical track record, to 1 or 2% for CNI and telco solarization, where we barely had any default. But with a sector like off-grid solar at 12% of risk, you could surely not offer it to a family office or to institutional investor. It's too risky. So we had several considerations, whether we concentrate only on CNI and telco solarization, where obviously you could go no blended. If we would have created a fund, we would have done it without any blended finance structure, or whether we keep on included off-grid solar and agri-solar equipment into the fund, and then we had to go blend it. For impact reason, mostly, we decided to keep the relatively risky sector, and then we calibrated the first loss at 10%, based on the track record and historical probability of default that we had over the last 10 years about those two sectors mostly, off-grid and mini-grid and agri-solar equipment. And we challenged that by discussing with our peers, but also some rating agency like microfinance rating agency to also see whether our estimation of the probability of default was a good one. And that's enabled us to launch the Gigaton Fund. It's the fourth generation of emerging market fund that focus on renewable energy at Mirova. And as you could see, we have been able through the last 10 years to scale a bit from the first fund launched in 2013 that was 15 million to this one that is today at 300 million, still in fundraising, but the target is for 400 million. And with this fund, we do private debt, so it's debt only to the decentralized clean energy sector that I mentioned just before. And we have enjoying the support of the Luxembourg government that invested in the Catalyst Junior Share and the European Investment Bank in the mezzanine tranche, alongside many other private and public investors. The second strategy where we use natural blended finance structure is for sustainable land use. So here it's our second vintage, the Sustainable Land Fund 2, still in fundraising. So this fund will invest like the previous one, the land degradation neutrality, in sustainable agriculture and sustainable forestry. So we invest in a relatively long-term project, 8 to 12 years, in emerging market only, in agriculture that have a very strong regenerative focus, very strong social co-benefits. Some of the projects we invest in are gathering more than 10,000 farmers. And we take risk in a sense that we want to invest in innovative solution for agriculture or agroforestry. Some of the projects are also targeting very fragile countries. We are active in Bhutan, we are active in many African countries. We target with the Sustainable Land Fund 2 more or less a 300 million fund. As of today, we plan a first close of around 100 million this winter. And as you could see here, it's a mixed debt and equity. And similarly, when we designed the fund, we used the track record we had in the first fund, named the Land Degradation Neutrality Fund 1, that was launched now 7 years ago. A great success, but still, if you look at the portfolio of this fund, we did 15 investments, and out of the 15, 3 had actually some difficulty moving restructuring because of country risks. There was, for instance, we invested in a nut tree plantation program in Bhutan, and then Bhutan was closed during 2 years for the lockdown, and they were not able to sell the nuts outside the country. So obviously, the aggregator that we have financed were not able to themselves be repaid by the farmers that were not able to sell the nuts, and then they were not repaid. So that's why when we look at sustainable land use and agroforestry, most of the defaults here are not necessarily linked to the technology, as it is the case for off-grid solar equipment or water pumping, but more also on country risk or currency risk. And that is why, similarly, we made some estimation of what could be the probability of default we could have, and we decided to go for a blended finance structure with a 15% Catalyst Junior Share. The previous fund, the Land Degradation Neutrality Fund, had 20% of first loss. So we are able to reduce a bit the first loss we needed between those two funds. And the fund is targeting pipeline in Africa, Asia, and Latin America. So that's typically two strategies where we use blended finance, but we also use it in sustainable ocean. I decided to focus on those two and to move to what it takes for us to launch a fund. Compared to several previous speakers, we have a good access to private institutional investors throughout the globe because Natixis sales team is composed of 500 persons that could sell the fund almost everywhere. So if we have to talk to CDPQ or Temasek, it's pretty easy to get approach to them. But what we do is very specific, and that's why we still have a lot of energy to deploy to gather all those stakeholders that you could see here. That's government agency, that's DFI, that's foundation, that's coalition with whom you have to discuss your fund to make it accepted so that you could receive the support of a government in the Catalyst Junior Share, or a grant from another government for the technical assistance facility. And that's something we have to do internally, because none of the other Natixis business is doing what we do here, and they have no clue and no experience there. What still makes it probably a bit different than others in the room is that we have a very good access to large corporate. One explanation is that we have also credit carbon fund, where we basically give back to the investor, and it's only corporate at this stage credit carbon, so not euro or dollar, but credit carbon. And a lot of the names you see here are also investors of our credit carbon fund, Danone and L'Oréal and the other. And that gives us, for the Sustainable Agriculture Fund, a unique access to those corporate. But just to show you the number of actors to whom you have to talk to before you launch a fund, so even if you are well recognized, even if you have Natixis platform, you still have yourself to connect to more than 100 persons for developing the fund like the Sustainable Land Fund 2. We actually talk to more than 100 persons at different organizations, to more than 100 different organizations for the Catalyst Junior Share only. Not to say the more or less 300 private investors that we have met. And similarly, we are part of many coalitions, but you know that, I will not insist. So, what are the lessons learned? First of all, it works. So each time we have been trying to launch a fund, we have been able to launch it. Not necessarily at the size we were expecting, not necessarily at the time we were expecting, but at least it has worked. It has worked also in a sense that we have been always able to catalyze private sector and private institutional investor and the real private institutional investor. Because if you look at the convergence statistic, for instance, you will see that out of the 100, if you take 100% of senior investor or so-called senior investor, actually in many blended finance funds, only 20% are real private investor. The other are either DFI that invest in the senior tranche of the fund, or family office that give up and have a trade-off between risk and return and are not as such classified as real private institutional investor. On our side, on the contrary, we usually are able to mobilize the private sector. And one of the explanations is that we start, usually when we design the fund, by discussing with the private institutional investor how they see these topics, how they go to invest, what minimum return they look at, how long they could invest, and to design the senior tranche, particularly in adaptation to what the private sector is looking at. So we only have to approach the Catalyst Junior investors, the government and the agency, and sometimes it creates some issue because the government may, or the foundation that will invest in the Catalyst Junior shares may be eager to have longer firm or different strategy, invest more in Africa, etc., while the private sector is more eager to have a global fund, shorter tenor or whatever. But for us, the mobilization of private capital is there, up to a stage that, for instance, for the Mirova Sustainable Land Fund 2, we already have received the commitment of 3 leading insurance companies for the first close, and we are now waiting for the Catalyst Junior share holder to come in to be able to unlock the more than 60 million now we have already received from the private sector. So capitalization work, impact works as well. If you look at all our impact reports, you will see that generally we have been able to achieve the impact we were claiming to achieve through our fund. So if you take, for instance, the Land Degradation Neutrality Fund, our Sustainable Agriculture Fund 1, we targeted to reach 20 million of tons of CO2 emissions sequestered. We are at 19 million, so very close to that. We targeted to have 100,000 of hectares of land restored. We are at 150,000. We targeted to work with more than 100,000 farmers, and we are working with more than 150,000 farmers. So, and it's the same for the other fund. Usually the impact narrative has been reached. One of the explanations is that we do blended finance in sector, only in sector that we know well. So when we design the fund, we design the risk side, etc., and the impact metrics are usually based on our previous track. So it's obviously easier to design than if you start something completely new, where you have no clue exactly how much of CO2 you will avoid or you will sequester it because it's a new sector for you. But impact promise has been reached so far. Risk also are there. If you look particularly on the renewable energy blended finance fund that we had, BTG fund or SET fund, we're ending up by using almost all the first loss. We had default. They were explained by some concentration in some specific sector or some country risk, but the investors that have invested in the Catalyst Junior share, they lost most of their investment. It's not the case in the sustainable agriculture, where despite some default so far, the first loss is protected, but at least the protection was used, which is a good news somehow, because it showed it was needed, it was used, and it works because the senior private investor, on the contrary, were fully repaid and get their return. So we are still in a narrative where there have been loss, the impact has been reached, but the senior investor has been protected, but the Catalyst Junior investor have been touched. And the protection has worked. That's also very important. What is more difficult is clearly the scalability and the replicability. We are always challenged by that, where we say, well, it takes us 18 months, 2 years, 3 years to launch a blended finance fund, and people say, why don't you just simply replicate the previous one? That's what we are trying to do with the Sustainable Land Fund 2. We took exactly the same waterfall structure. It's the same team, same geography, everything's the same. And still, there's a lot of investors, particularly some government or foundation, coming in the fund and then saying, well, could we rechange a bit the waterfall structure? Could we rediscuss the term and condition that you had in the previous fund? So we are facing usually the difficulty of replicability from one fund to another because investors change. Not the private sector, because usually we are able to keep more or less the same institutional investor from one fund to another, particularly if the fund has worked well, but more on the Catalyst Junior share, where we have new foundation, new government, and they come with new criteria. And that's really creating a difficulty for replication and for scalability. One of the difficulties we are experiencing is clearly the lack of capital, catalytic capital, first loss capital. Like us, if you want to launch a 300 million fund with a 15% first loss, it means you have to find 50 million of Catalyst Junior shareholder. It's pretty big, so it means minimum 2 or 3 governments, minimum 2 or 3 foundations. And unfortunately, there's more people on the room knocking on the same door, and those doors have less money because the public head of development is decreasing. And it's more tricky today. I've been in this industry for 20 years, so it's more difficult today than it was 10 years ago to get access to a Catalyst Junior shareholder. And there's a timing issue. Private sector move pretty quick, so usually in 6 months they are able to do the due diligence, to assess, etc. We are a bit specific because with Mirova we work with, I think, 600 of institutional investors throughout Europe, so Allianz, AXA, IPG, all of them has investment with us. So we have already the due diligence at the asset management side, so they just have to perform the due diligence at the fund side, but still it takes them 6 months. On the public sector and on the foundation, some of the process could last up to 18 months, if not 2 years. So at what stage do you approach the private sector? How you could combine a timing that are so different from one to another, and your pipeline as well. So it's always a bit challenging. And frankly, there's no lesson learned, because sometimes we launch a fund, it works very well with the private sector and the public not. Sometimes it works well with the public sector, not so much for the private. So we always try to say, well, what went wrong? But actually, it's very difficult to define any specific rules here. And even us, we are still starving to raise one fund after the other for those blended finance strategy. When it comes to private institutional investor, while generally we are pretty successful, it's still not easy. If you look at the name of the large institutional investor that invests in blended finance fund, it's more or less the same guys than 10 years ago. There's a couple more every year, but still, there's many explanations for that. Several large institutional investors are not eager to invest in emerging markets. They are not familiar with our strategy, what is access to energy in emerging market, what is natural capital solution in emerging market, or preservation of biodiversity and the like. So some subjects are very new. But also a lot of them are not familiar with blended finance. And they still have, even if you come with the protection, they still have the impression that the risk perception of a blended finance fund is quite high. It's also because we explain that it's protected, then it gives them the impression it's risky. You know, if you tell someone this car is safer because there's a lot of protection, you may have the impression that actually there may be more accident with this car than another. And that's why we generally speak a bit too much about the protection we are offering them and a bit less of what is the investment universe we invest there and what exactly could it be in terms of impact narrative. But also the complexity of the structure. A blended finance fund remains a complex vehicle with different shares, different rights. DFI are asking for some development finance institutions are usually asking for specific rights that they want to have, which is normal. It's the US government, it's the French government, it's the European Commission, whatever. So they feel they should deserve a bit some specific voting or specific right in the fund that a private institutional investor should not necessarily have, but then it goes with complexity. We have difficulty to rate the tranche of the fund. The underlying assets are not known by the rating agency. We are active in countries that are not rated for many times. And then the rating agencies themselves have difficulty to integrate the blended finance structure into the rating tools. And as such, when you discuss with, for instance, LNG, Legal and General in the UK, they invest only in funds that are rated. So if your tranche is not rated, they could not invest. It's as simply as that. For others, it's just that instead of putting 50 million, they will put 10 million because the fund is not rated. And the last point is the lack of liquidity. If you invest in Sustainable Land Fund 2, it's for 12 years. If you invest in the Gigaton Fund, it's for 10 years for a private investor, and it's still long. And they are not able to sell the share or the notes easily. While technically it could be sold, but it's over the counter, there's no organized market. Or if the market, or if they could sell, and there's a bit of market, it's not the kind of market that a large institutional investor like APG or Allianz will recognize. And that's why they look at those investments as if they are locked up for 12 years. And then it's used a lot of their equity. And then if they make the comparison between the risk, the return, and the equity they have to put toward the project, it's obviously less interesting than many of the funds that we are proposing at Mirova in developed markets. So if you look at energy transition, for instance, we are proposing energy transition fund in Europe. The investor will receive around 8 to 9% in euro. They will enjoy a specific solvency treatment, so the EU directive, so the allocation of capital will be small. In the invest in the Gigaton fund, they will receive 5 to 6, protected, but only 5 to 6, and the allocation of capital will be higher because there's no specific solvency treatment, and it's in emerging country. So basically, when we are selling them, our emerging market fund is really usually with a lower return, more equity to be put, and they have the difficulty to factor exactly the protection. That's it, but again, it works, so that's why we are here, and we all hope that it might be even easier in the future to develop new products. For myself, for instance, I always have to convince the management of Mirova to go in emerging markets. So for instance, if you take our Sustainable Ocean Fund 2, so we had Sustainable Ocean Fund 1, that works pretty okay. We are thinking of developing the Fund 2. We already have private institutional investors, European, that tell us, why do you go to emerging market? You know, if we look at the statistic, if you look at the performance, better to do a Sustainable Ocean private equity developed market. Why do you spend all this time developing another fund for doing an emerging market where we know there will be default, where we know it will take you 18 months to get the Catalyst Junior share, etc. And it's tough to convince the management, yes, we'll have to spend more money at the asset management level to convince someone to put the first loss, etc. So that's why I think here, particularly for the donors, the DFI, the foundation, it's an important metrics to integrate, because for us, that's really the key driver. And most probably for the next Sustainable Ocean Fund, we will do it only for developed countries.